Paying off your real estate mortgage on your investment property could actually make you poor. Most investors dream of being debt-free, but here's what they're missing. When you finally crush that mortgage and own your property free and clear, something unexpected happens. Your monthly cash flow shoots up, but your return on equity takes a nosedive. Let me break this down. Picture this. You've got a property worth $500,000, generating $40,000 in annual income. With a mortgage, your cash-on-cash return might be 12%. Kill that mortgage, and suddenly your return drops to 8%. Meanwhile, Treasury bonds are paying 7% with zero hassle. Why? The secret lies in leverage. That mortgage isn't just debt, it's a tool. When you keep smart debt on a property, you're using other people's money to boost your returns. Your equity isn't just sitting there, it's working harder for you. Think about it. Would you rather have 100% ownership of one property making 8%, or use that same capital to control multiple properties making 12% each? The math doesn't lie. So what should you do? Here's the move. Instead of rushing to pay off that mortgage, consider if your money could work harder elsewhere. If your property's cap rate is lower than what you could earn in Treasury bonds, keeping that strategic debt might be your smartest play. Remember, being debt-free feels good, but making smart money moves feels even better. The velocity of your money is powerful. Sometimes the conventional wisdom isn't so wise after all.